Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. We're back, finally, back from our trip here. Actually, this is pre-recorded, but today we'll be back for the closing beat at 5 o'clock live if you like watching. We've spent the week so far talking to the very beginning, basic sort of investors that really are just getting started. There's just not enough content for people like that. And so I know it's boring to some of you, but I hope you enjoyed it anyways. Well, today we're talking about something a little bit more advanced. We're talking about speed and volatility. Now, I always talk about this with our clients because it's an easy way to explain how much fluctuation you should expect in your account relative to the performance that you end up seeing. It's not linear, by the way. You can't accept more volatility for a greater return. There is a sort of a decay of that. We've done videos on that in the past. But our portfolios that are on our website, our goal with each of those, of course, is posted, and you know the objective of each fund. We build and manage our own funds here, but our goal is, of course, the best possible return for the least amount of volatility. I don't want you guys investing for retirement, seeing massive backs and forths every day. One day you're up 1,000, next day you're down 1,000 or whatever. We don't want that, right? We want the best possible return, and we want to bring that volatility down at all costs. Well, there's some ETFs out there you may be interested in, and they're called low volatility ETFs. They're getting a lot of attention lately because they're beating the market. They have beat the market. So all of you that say you can't beat the market, you're wrong. I don't know how to say it. I know sometimes I look silly up here saying you can beat the markets and you can build a portfolio. Here's yet another example of a portfolio or an ETF that is beating the market. There are two symbols. We're going to talk about one of them today. The one that we're going to talk about today is USMV. The other one is SPLV, both of them beating the markets at the moment. SPLV, I should say. And like I said, they're getting a lot of attention because they're doing really well, but they're doing it with less volatility. What does that mean? So you have an expected return, right? Or you're positioning yourself to grow in some amount. And if you're not, you need to look at this, right? Don't just pick random investments. You want to pick investments that actually are going to get you to that goal. You're invested aggressively enough to hit your overall goal. Well, the USMV is the one that we're going to focus on today. If you look over the last 5 years, this thing has returned an average of 12.55%. It's not that old, by the way. I think it goes back to 2011, September, October 2011, somewhere in there. The S&P has returned, as of this taping here, 11.63%. So number one, if we don't take it any further from here, you know that there's an ETF out there that has a track record. It's not horribly long, but it has a track record of beating the stock market by at least a little bit there. Here's the key. The stock market is, I'm going to cross this out for a minute. The stock market wiggles around like this, right? So your day-to-day fluctuation looks like that, okay? That may be fine with you. That's okay. But what if you could get a bigger return and see fluctuation like this, right? Meaning the day-to-day back and forth wasn't as crazy as the overall stock market. That means something to a lot of people because some people get scared to invest in the markets. They don't know that things will recover and everything will be just fine in the future. They're genuinely sort of nervous about this, and it's kind of my job to try to help you guys try to point this out for you. So the USMV, I'm not suggesting you buy this, by the way. I'm definitely not making any recommendations here. Thank you. Got that on record. So look through the last decline in the market. So in May, the market pulled back after having this big run up. It pulled back. And the whole month of May, it was just a decline the entire month of May. The S&P 500 lost 6.38%, somewhere in there. Okay? That's not a big deal, right? A lot of people can say, all right, yeah, markets go up, markets go down. That's totally cool. But what if you had the USMV, which actually only pulled back like this, 1.61%? You got the same performance on the way up and continue to get the same performance on the way up, but you didn't have to suffer as much on the pullback. Meaning for those of you that are really nervous and the markets sort of scare you, you didn't have to suffer. You got to see that thing pull back a little bit. All right? So this year so far, the USMV is already up 17.65%. Again, as of when I'm doing this now. I'm sure it's changed by now. But the S&P 500, 15.1%. You're doing better than the market, and yet you're not having as much volatility. Like I said, that means something to people. The biggest loss for the USMV was actually just December 2018. It lost 7.26%. That sounds like a lot, but do you remember what the stock market did? The S&P 500 fell nearly 10% in December. So how is it that this fund can generate more returns on the way up and less pullback when things get weak? It's actually quite crafty. It's what we do here with our portfolios at Jazz. This is just an ETF that you can buy if you don't want to work with us or you don't need us. That's okay. The USMV is made up of 16% tech stocks. That's its biggest holding. The biggest sector it has is tech stocks, 16%. All the other sectors are a lot lower than that. So you go, okay, I know tech stocks. Tech stocks are rather weak, or rather volatile. So how do they manage to accomplish that? It has everything to do with the stocks that they pick. It's just like how we do it here at Jazz. So in the USMV, you got tech stocks in there. Well, instead of choosing something like Square, which is highly volatile, SQ is the symbol there, they look at it and they say, well, can we get the same returns but be somewhere else and stay within the tech space? And they can. Believe it or not, Visa is a tech stock. Symbol is V. So the difference between the two is about a third less volatility. So you've got Square wiggling around day to day, highly, highly active, but you got Visa over here, 1/3 the day-to-day back and forth. We've compressed the overall volatility in the account, that back and forth that we're looking at. The performance is actually the same. Both of these stocks are up just about the same amount year to date, at least as of now. All right? Instead of choosing something like an Apple, which we all know is volatile, right? It moves around. It's going to have a pretty decent little back and forth. You've got to be sort of willing to ride the Bronco if you're going to be playing along with Apple. Instead of choosing Apple, they choose Motorola, right? You get about half the volatility here, and you get almost identically, oh no, in this case, you get 50% greater performance in Motorola, at least so far here. So that's one example of what they do. You can look up at their holdings in the, you can just look up USMV holdings or something, and I'm sure it's right there. But so that's how they do it. When you look in the financial category, instead of choosing like the high flying, the JP Morgans and things like that, they choose insurance financials, which are like Aflac, right? So they don't own JP Morgan, they own Aflac. And so you get this compressed volatility, but you're not sacrificing the performance. It means less holdings, right? You're going to have less positions overall, and it means an actively managed fund. But the USMV, I think, has an expense ratio of 0.15 or 0.16, somewhere right in there. It's next to nothing. Right? It's pennies to participate in less volatility, the same or slightly better performance. Add to that, it yields just about the same as the S&P 500, 1.9%. Fluctuates a little bit, but so does the S&P. So you're getting the same dividend yield, right, or very, very, very close to the same dividend yield, better performance, and less volatility. All right? We did a little research on this one here, and the USMV, since inception, like again, I think it's October 2011, right in there somewhere. Since they came out, they have only lost more than the S&P 500 in a given month 6 times. 6 times you had to see the USMV fall, 6 months, you had to see it fall more than the S&P 500. That's not bad, right? We're talking 60 plus months here that you're going back and looking at. You can handle that, right? And not only that, it's not like the USMV fell 10% and the S&P fell 5%. We're talking about a fraction of a percent difference, if maybe 1% at the most, as we look back on those. So, bottom line is, can you create a portfolio or find a portfolio that beats the market? Absolutely. Remember, the S&P 500 is a man-made index. It's not magic, right? They put it together. They just keep changing the stocks out as they need to change them, keeping about 500 to 505 names in the S&P. Anybody else can create something else that moves faster or slower, and these guys have created something that not only moves faster but reduces the volatility. That's what I spend a great deal of time on talking about in our monthly updates here for our customers, to say, all right, if you're in this fund, it got a little too volatile for us. We don't like to see that, and therefore we made some adjustments to slow it down, compress the volatility so you guys don't have to be so scared day to day. right? No other financial advisor really does this because they just buy mutual funds for you. We just take it a step further and say, hey, that's our background, is building stuff like this USMV, so let's build that for our customers, but have no expense ratio. Let's make it to where it doesn't cost them anything. We can adjust all we want, and it's not going to hurt them, right? It's not going to cause them any tax. It's not going to cause them any slippage like in the commissions and sort of the bid-ask spread and things like that if you really want to get geeky. All right. Anyways, that's all I have for you here. We'll be back later with the closing beat live for the first time this week. We've got the Fed announcement and everything, so we'll be covering that. No doubt the markets are active, and so we'll want to help you out there. If you like it, join us at 5 o'clock. It'll be live. You'll get a notification if you hit the subscribe button and turn on the bell, and we'll just cover the stock market. What happened? The good, the bad, and the ugly. I always try to teach a little something in there and have a focus stock or focus sector to teach you maybe a study or some sort of data behind it, so you learn a little bit more. We're a teaching firm here at Jazz Wealth. Love teaching our customers, and maybe we'll see you later. Enjoy.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.